Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. Just got back from Toronto. I was there at the annual Veritas Housing conference, and did a speech on Vancouver. So I want to sort of discuss how that event went, all the sort of insights that I was able to accumulate through various people. So, I think to start it off, we actually did a tour of the Toronto pre-sale space, just sort of getting a sense for what's out there. And basically, it's one thing to sort of be in Vancouver and look from abroad and sort of charts and data. And it's another thing to sort of be there in person, actually talking to people that are in that industry, in that business on a day-to-day basis. But basically, in my summarization, that Toronto pre-sale market is red hot. People are basically, there's a lot of speculation. Everyone that I pretty much talked to was bullish. And the main bullish argument was, population growth. There's just so much happening in Toronto. I think there's just a lot of excitement and buzz around the growth of the city that, I found very interesting, because I also found a lot of arguments and a lot of commentary that reminded me of sort of Vancouver 2017, i.e., the detached market was kind of flat. Condos were just continuing to go up. Pre-sales were red hot. And there was a lot of still narratives around why condos should be continuing to be hot. And that was, affordability, stress tests. And so I heard a lot of that. So that kind of, raised some alarm bells. But I will say this about Toronto, on the more bullish sector, is that you definitely have a much more vibrant real economy in terms of jobs and real companies moving in. You certainly have a lot more of the population growth, which, I'll get into is cyclical. But, just going into context, the pre-sales there are still selling well below what they would sell for in Vancouver. So for example, I think I visited the most expensive project in one of the more prestigious areas of Toronto there, and they were asking $1,800 a square foot, and it was kind of this luxury building. But here we have, anything downtown Vancouver starts at $1,800, and we saw that go up to $3,000 per square foot. So I don't think Toronto's, maybe nearly as overvalued, at least particularly when incomes are factored in as Vancouver. But no doubt, I think there's still a lot of froth there. But we'll kind of get into that, because I think that, I went to, as part of this whole thing that I was involved in, we had a private dinner with a lot of basically hedge funds, fund managers. One of the guys in the room was a billionaire, and this, the conversations that we're able to have, there was no consensus as to what the outcome was. Everyone was there learning. It's not like you come here and you look into the comment section. Go look in the comment section after this video, and you'll see that everybody is convinced they know exactly what is going to happen. And if you're not in that sector or that mindset, that you're an idiot. And I think that what I really took away from that is just the overall broad views, that people certainly had their opinions and beliefs and views in the market, but they were certainly willing and open to listening to other perspectives, including a guy with a net worth in the B's. Just kind of goes to show you that, the true smart money doesn't necessarily know what's going to happen. You just kind of place your bets and see what happens. And at the end of the day, this Canada trade has certainly been playing on for a long time. But just to summarize this housing conference and this housing event is, we heard from the chief economist of the Canadian Real Estate Association. We heard from Urban Nation. I heard from credit analysts, again, hedge funds. And so just the wide array of people talking at this event, basically that, if you look at sort of Canadian housing today and the current situation, the current backdrop, which is low interest rates and full employment, that it shouldn't be a surprise that housing is still going in Toronto, and it is recovering in Vancouver, i.e. sales activity is picking up. But there's significant and undeniable headwinds And those are ultimately, we know, the excess leverage in the Canadian economy, particularly amongst businesses and households in Canada. They are the most levered in the G20. So basically, debt servicing ratio actually just hit an all-time high in the third quarter of 2019 for households. And this comes at a time when it surpassed the 2008 high when interest rates were around 5%. Right now we have debt servicing payments at record highs despite interest rates being at all-time lows of 1.75% and mortgage rates being around 2.6%. So the Canadian consumer is so exposed to any sort of increase in interest rates. Now, I'm personally in the camp that interest rates are going to continue to fall. I think we're in this sort of a deflationary camp, a death spiral, so to speak. But what it really hinges on, and this is sort of the premise of the event, is it ultimately comes back down to employment. The only way that you're going to see a significant reduction in the prices of real estate in Toronto and Vancouver and the other parts of Canada is if you have weakness in the labor market. Because credit is cheap, because you have an inflow of migration, Canadian migration flows, population growth just hit the highest has been dating back to the 1990s. And what you need to understand is population growth is cyclical. This is something we talked about at the event, i.e. you get lots of migration and inflow into cities and into countries when the labor market and the economy is strong. You do not get that. That actually will turn into net outflows if you get a recession and job layoffs. A weak labor market will create a reverse effect. So if you take Toronto, for example, you're actually, if this current rate of population growth continues and the labor market stays as hot as it is, you're actually underbuilding. If the labor market slows down and you get job layoffs, then the population growth will ultimately reverse and you'll actually be grossly overbuilding. So this can go really either two ways. And so I think that was the crux of it. So all we have to do is actually, if you want to get an outlook for Canadian real estate, what you need to be looking at is look at what's happening in the global economy, which is, particularly the US, because if the US and China and Europe and all these larger economies, because we're all interconnected, if they catch a cold, Canada gets the flu. So I think that there's some very concerning things happening right now in the ISM data, basically showing a significant drop-off in PMIs all around the world, which is leading recession indicators. So that's not to say that a recession is imminent, but it really comes down to if central banks can extend this cycle, then everything is fine. And if they can't and you get that recession, then I think that's what makes housing seriously vulnerable to a downturn, not only given because of the growth in home prices and the dependence of that and the leverage in the system. It makes you significantly prone to those vulnerabilities. So you don't have like the US, right, where the households have already deleveraged, so you're probably looking at basically a mild recession. In Canada, you have these excess amount of debt, right? So as an example, if you're to buy a house in Vancouver or Toronto, and it's fine. Two families can manage to squeeze out a mortgage for a purchase price of 1.5. They can make it work with two people working full time. But again, if you get one of those spouses laid off, all of a sudden those debt burdens become significantly burdensome. So one of the things that we talked about, just to sort of summarize this, is what you're actually seeing is a significant drop-off in the number of new listings in Toronto and in Vancouver. And so basically what this is because is Canadians actually have the holding and staying power, not only because the equity is built in, because there's no real pressure to sell. There's no real reason to sell real estate. You're not forced. But if you get that economic shock, then of course that puts the pressure to the gun, right? Now all of a sudden you can't wait out 1, 2, 3, 4 years to sell your home for better market conditions. All of a sudden there's more of that pressure to put real estate on the market. And the same thing with investors and speculators, which are ultimately driving the Toronto pre-sale market. Again, when people start getting laid off, etc. So that was kind of the overall consensus view of the event, is that looking at it today just on paper, assuming that the job growth and the population growth stays where it is, Canadian real estate should continue to perform well because interest rates do not appear to be going up, and that's where it is. So it really ultimately comes down to the labor market. Now I'm going to quickly switch and pivot to the Vancouver real estate statistics for the month of October, just to sort of quickly touch on that. You had sales absolutely rip 46% year over year. Again, coming off the low base effects of September 2018, when sales, it was one of the weakest Septembers on record. So sales are actually still slightly below the 10-year average, but what we're basically seeing is significant volume and uptick in the affordable markets in Vancouver. The affordable entry-level points in Vancouver are performing relatively well. The weakness continues, and there's still downwards price pressures at the luxury end of the market and in the pre-sale market. That's where the weakness is being concentrated, and the volumes are still terrible. But the what's happening is, again, because you have that full employment, low rates, you still have locals here. It's come back to this local end user market that are trying to squeeze in for affordability reasons. And what's interesting to see is, you know, we've seen the prices drop off. So this is the the condo market, for example. The benchmark prices have dropped off. I would say prices are down about 15%, and now they're starting to sort of, that rate of change of the decline is starting to pick up, which again, in my opinion, suggests that we've kind of moved into this sort of flat market here, where things are kind of going to begin to move sideways for a number of months until we get a more clear outlook on the horizon. So. But what's interesting, again, as I was talking earlier about the decline in new listings, I think this chart really ultimately summarizes it best. This basically shows Greater Vancouver detached home sellers. This has been a terrible market for detached home sellers for 2.5 years now. And prices have come off anywhere from 15% to 40% on the high side. And what you're actually seeing is not a flood or panic and everybody running for the exits. What you're actually seeing is sellers are taking their house off the market, and that is helping suppress the growth in inventory levels, and it's keeping prices from actually falling further or more than they should. So all you have to do is look at the 12-month average of new listings for Greater Vancouver detached homes. As you can see, there's a significant decline. It's actually the most significant decline, even more so than the 2008 financial crisis. So the question, again, ultimately comes down to is, how long can sellers hold out for? Well, they can hold out for as long as they need to, given the amount of equity, and because the rates are so cheap, you can continue to sort of, the costs of servicing that are relatively cheap. But again, if you get that economic shock, i.e. in the employment market, all of a sudden there's more pressures on people that, they might not be able to withstand, that holding power diminishes significantly. So I think that pretty much just summarizes, not only the Vancouver market here, but I think in Toronto and just in Canada in general. People always say, the debt bubble has been talked about for the last decade and nothing has happened whatsoever. The U.S. hedge funds continue to be wrong on that, so to speak. And what that catalyst is ultimately just, again, it comes down to, I think, the labor market. And I think to get a picture of that, I think we really have to look outside of Canada, because Canada is such a small fragment in the global economy, where we've all become so connected due to the financialization of the economy. So hope that video helped. Otherwise, see you next week.